Alright, this is the last episode in the series. This is where we talk about access to the groups that you may want to get access to regarding a cash flow strategy, or also the groups that you might need to understand and how they differentiate in the market. So, property syndicators, when I say property syndicators, I mean the guys that have the exemplary track record. There are a lot of people out there that have been scared by this because they haven't been dealing or they haven't been made aware of the larger groups with a very strong track record, who have a major resources team in place to analyse, do due diligence, and understand the strategy behind what they're buying. That's very, very important. There are groups that we would like you, if you would like to reach out to them, we can talk about and what they currently have and what might currently be upcoming, and that will relate back to the commercial property specifically and the defensive tenants within the trust and how diversified the income sits within their trust. Now, there are groups that are not listed, so I'm referring in a state of today's crisis, economically, globally, locally. An unlisted property fund is the best location to be, in my opinion. Someone who is listed is, or a REIT or themselves, are dependent on the stock market and people buying and selling their shares. To be more protected from that, you want to be a part of an unlisted property fund who's not affected by the stock market. That's very, very important to understand here. When we analyse the unlisted property funds, we would ask you to reach out to us and find out who they are, and we can make contact and introduce you. But once again, every syndicator who's unlisted, who's got a fund or a trust, that should be diversified, it should be defensive right now, giving you secure cash flow strategy, giving you a very, very optimistic equity uplift in the future. You need to make sure that they're underpinned by defensive tenants. Once again, relating it back to, you need the logistics guys, you need the supermarkets, and I don't mean a neighbourhood centre that has 50% of its income underpinned by Woolies or a Coles and the other 50% underpinned by cafes and gyms who are unfortunately taking the big hit right now. I'm talking about a standalone supermarket where, or at least a supermarket with a medical centre or a pharmacy. So I'm talking about where more than 90% of the income is underpinned by defensive tenants. Now, a trust that might be diversified is one that has multiple properties in multiple states. It has multiple defensive tenants that make up its nature, and a trust that has a very low gearing. That's important to understand, that they haven't got a high gearing. They've got a conservative LVR of no more than 55%, potentially 60% in cases where it's 100% defensive. They've got very good interest cover ratios. That's very, very important. It's not about just finding one asset. You want to understand the metrics behind the trust and the fund. You want to understand more than just the real asset itself, the look and feel of the building and the tenant's name on the signage. There are a lot more indicators that you need to analyse when making these decisions. And we're happy to explain what each of those indicators are, and we would implore you to reach out to us if you have queries or questions behind what they mean and who's out there doing what. We do sell a lot of these assets to these groups. If you are also a person that can afford to buy one yourself right now outright, we'd be more than happy to source those assets for you. If the cash flow strategy is one that you want to adopt and one that you see as a strategy that's more defensive and more secure when things like this happen. Unfortunately, we never want these things to happen, but it's a part of life. They do happen, and that's why having a cash flow defensive strategy should be adopted in our opinion. Thank you very much.